I'm just going to pull up a balance sheet just so you can see what the balance sheet looks like. We will talk about the report, the balance sheet, and things like that down the road. But let me show you for the sake of explaining assets, liabilities, and so on. Okay. If you have your manuals or you go online to the digital manual, there are some chapters for anything that we do. The Getting Started with Accounting walks you through what I'm going to show you in more detail than what I'll explain, okay? And then, of course, the general ledgers, more processes, and so on. The way the fund accounting works, you have your assets, your liabilities, and your funds. So your assets up here, you have like cash accounts. That's physical bank accounts that you have. Cash. It's money on hand. Maybe I don't have, some people will put their investments up in there on the cash account. You might not regularly use it, or savings accounts and things like that, but it is money that you have at the bank. So think of it that way. And that physical. If fixed assets would be like your properties, the value of those properties. And those values do change over time. And most of the time, as state offices, your auditors provide a lot of times that information to you. Not always. Depends on your auditor. But fixed assets, that's going to be your properties. If you have any vehicles, what the vehicles are, and all that. Some people will put their equipment on there as a separate thing and put it that way. So it's just so you can kind of see what you're worth. What am I sitting on? If I was to sell everything right now, what's my worth? Okay, so that's what that would be. Short-term assets, we'll talk about this a little more in depth after lunch. It's going to be like accounts receivables. So if I know we've had several people ask about, we rent out our campground and they need to pay bills. Or I have some pastors or what have you, or churches that have taken money, borrowed money, like a loan from the office, and I need to make sure they're making their payments on it and all that kind of stuff. You can use accounts receivable for that if you'd like. We'll talk more about it. You create customer report or customer record. You can put and bill them with it, and it keeps a running balance. So if they rent something, you can bill them for that, and then you can, when they make that payment, you can keep up with it. Well, when I post that to the into the ledger, this right here tells me that, and you'll hear this later, we haven't posted the billing. But ultimately, what you should see in here is money that's due to you that you've billed to people. Okay? So it's a short term. You don't quite have that money yet. That's due to you. That would be what that is that you see here. Liabilities would be things like your taxes. If you don't, most state offices, I would think, probably pay their taxes the same time that they do the payroll, but it depends on what you have set with the IRS. Either way, when you post payroll, as we'll learn, the tax portion of it goes into here until you go to pay the taxes, and then it leaves from there. So that's a liability because it's money I owe to people. So liabilities, what do I owe to people? Assets, I physically have them at the bank, or if I was to sell everything, I could have, and it actually was for what it was worth, I would actually have that kind of money, or it's money that's due to me from other people if I do billing. Okay, so if liabilities is also something that I owe, money that I owe, a mortgage would be something that I would owe to people. The balance of the loan, liability. Okay, so that's what a liability is. Then when you go down to funds, one good way to think about some funds, it would be like little mini bank accounts. We don't run into this, at least we didn't in Ohio, with churches, at least years ago, and there are still some churches out there. You have the church checking account. Well, then the women's ministries decided they needed their own checking account so they could keep track of their money. And then the youth department needed their own checking account. And you had like a ton of different checking accounts, right? Or if you've worked with churches, you see that. One church, it wasn't a church guide. I just remember the lady calling me years ago. she was like, hey, I need to merge some assets together. They're letting me finally go down to about 12 checking accounts. I was like, 12? Like physical checking accounts? She was like, yeah, we have 20 right now. I was like you actually, I even had to ask because I really thought maybe they just came from like QuickBooks, you know. They were physical bank accounts, but they were doing it because they were trying to keep track of each department. So I got their idea, but she, now that they had CDM, realized you don't need to do that. You can keep track of the balance of each fund through this. I have one checking account at the church, and I can see all of it. In Ohio, we had one checking account. I mean, obviously different savings and things like that, but we had one checking account. We knew how much the youth department had or didn't have. We knew, you know, the music ministries and all that. Chuck Knoll would always say there's certain events in the youth department that would just suck the life out of you financially, but they were so worth it. And it's right. He is so right. So it was always up and down, but they were worth it because you're investing in our kids. But you could see that. So, for example, in this one, the building fund is in brackets. That means they have $8,000 in the red. We'll talk more about that here in a little bit. But I can go through and have my missions, and we have $9,000 currently in missions. The missions department did not need to have a separate checking account. It all is flowing into the one. But as you'll see in a little bit, we're able to break it down and keep track of what their balance is. I can also pull reports of all the money that's come in just for that fund or gone out. Or if I create an expense account, you know, for different things that's more detailed, I can do that. And I can, at the tip of my finger, one little click, I can see exactly how much we spent for this building fund or how much we spent for lights in the building fund, because maybe I wanted to create an expense account for that. Whatever account number is tied, whatever fund these account numbers are tied to is what goes up and down. And so because of that, you're able to have these funds and not have that many bank accounts. She knew she didn't need 20 bank accounts. It took her forever to explain to them that she didn't, so they let her go down to 10. She really only needs one, but they couldn't quite grasp it yet. If we can grasp the fund accounting, we don't need all of that. Is it wrong to have it? No, but I wouldn't want to have to balance that many checking accounts and move money around. But you don't have to do that. You don't have to move money from one checking account to another just to keep track. You do that in the funds. So it's important to understand what these balance sheet account numbers do and what they are. I'm not going to make a missions fund a liability because it's not a loan. I don't owe it. I can't even put income and expense numbers to that liability. I make it and attach it to a fund, or make it a fund, and so I can attach my numbers to it. So far, are you with me? Yes. Okay, good. I'm glad. So let me explain something. When you're doing things, your assets plus your liabilities should equal, your funds plus your liabilities should equal your total assets. So if I was to add my liability and I add my funds, they should equal the total amount that I owe or that I have in my assets. We will go more in depth with this in a little bit, but I want to give us a general overview to show you before we break for lunch. So when you add those two together, that's going to equal your total assets. If it doesn't, your balance sheet at the bottom is going to tell you have a difference. That's why you have a difference, because your funds and your liabilities are not equaling your total assets. That being said, so you have your assets. Anytime you make a payment or you put in a deposit, you're going to put it into the bank. In your ledger, it's going to go to the asset. But we do double entry. So yeah, it affects my bank account. Well, what else does it affect? What fund is it going to affect? What income or expense number do I need, and making sure it's connected to it? So you got, of course, your liabilities. With your funds, you can put an unlimited amount of income and expense numbers and connect it to that. And you can do it without income and expense numbers. I've been asked, sure. But you've cut off this bottom section right here when you do that. Does it work? Does my balance sheet work? Yeah. Because your funds plus your liabilities equal your total assets. So if you use fund numbers all the time, yeah, your bottom line is going to be right. But when you're asked how much money did we spend for lights, and you don't have an expense number for lights, you just put it all on a building fund number, now what? While your bottom line works, you've cut off the ability to gather more detailed information. And that's why it's so important to use income and expense numbers and then attach them to the funds that you want to be affected by. Are there times that you just use fund numbers for things? Oh yeah. We'll go over that even more in depth. In fact, what I found out through our meetings, some of these state offices, you guys use them monthly because you transfer for budget out of the general fund into the youth fund, or out of the general fund into the music ministry, or every single ministry. Well, you don't want it to show up on that income or expense report, right? Because then you're going to get asked really quick by the state council, why did we spend that kind of money for the youth department or the music ministry? Well, you didn't. You're just moving the monthly budget into that fund, if that was what your process was. So because of that, because you don't want it to show down there on one of those, you would use just the fund, because you're just doing an internal move. You're taking the money out of, say, the general fund, and you're moving it into the youth department. It's internal. It's not going to show as an expense or as an income. You can get reports for it. Ledger by accounts reports, probably my favorite for that, and I'll show you. So it's not that you can't see it and it can't be tracked. That has nothing to do with it. It's just the amount of detail in the reports. But your fund-to-fund transfers, you do want to use those fund numbers with that, okay? I always tell people, if you're doing transfers, what did I say yesterday? Multiple times, you're going to hear it a lot with accounting. Think with the end in mind. Do I need it to show on an income report? Then I need to use an income number. Do I need it to show? Do I not want it to show because it really wasn't, we didn't actually take it out and spend it? Then I don't want to put an income or expense number. I want to use a fund number and then use a different report. Does that make sense? I actually it's like clicking. I see eyes going, oh, this is great. I'm so glad. Sometimes accounting, you never know. So I try to go as slow as I can. But that is very important. The other thing, while we've got a couple of seconds, I want to show you. I used this program for years. Before I even show you, those who do use the program, when you go to do like a journal entry, how many of you guys print the balance sheet, look at the fund to see what the balance is, go to the ledger, do your fund-to-fund transfer, hit save, print the balance sheet, went, wrong way, do this again. And you do it double times. So there is this chart. If you want this chart, it's in the manual. It's the chapter 14 if you have the PDF. Print it, laminate it, paste it somewhere, blow it up, paint it on your. It was my lifesaver for this. If I want to take money out of a fund, then I'm going to put the money in the debit column because it lowers the fund. If I'm going to move money from the general fund to the youth fund, then I'm going to debit the general fund, right? Because I'm going to take the money out of it, and I'm going to credit the youth fund. Does that make sense? It's like a good reminder if I need to, if I'm taking money out of checking and moving it into savings, then I'm going to credit my checking account, and I'm going to debit my savings account because I'm reducing and I'm raising. As simple as this chart is, it is such a lifesaver when your brain can't remember and you print that balance sheet, you do it backwards, you do it again, and it's like, why? I do this every month. Why do I get this wrong every month? I was there. So to be able to do it this way, this chart's helpful for that. When you're doing those transfers, you can see if I'm going to reduce or I'm going to raise the funds or the assets.